So you're retired or you don't have very strong income and you need to make repairs or you need access to cash for some other reason. Maybe you've got a medical assistance that you need or a medical renovation to your house, or you want to help your family with a down payment, or you've got some other reason that you just need access from your house. It could be for consolidating debt, it could be for taking a trip, it could be for anything. But the point is, you're not making much income, you have a almost fully paid off house, and you need access to cash. So maybe you've looked at other options, like you went to the bank, but the bank says you can't qualify because you don't have enough income. You went to some other lender or a broker and they offered you a private loan, but the rates are too high and you can't make the payments. Or you've got some other option, or they want you to sell the house, and none of those options are good. So how do you get access to the equity in your home so that you can do what you need to do with your house, for your trip, for your expenses, and get that money to work? All the other options haven't worked. What can you do to get the equity in your home? You're probably already aware of the traditional lending, like a mortgage on your house. You go to the bank, they qualify your income, they give you some money, and then you make monthly regular payments and the mortgage gets smaller and smaller. Problem is you don't qualify for those. You don't have enough income and you can't make the payments. So then what's the next option? You might have heard of something that's called a reverse mortgage. It works very similar, just in the opposite direction. A traditional mortgage, you make payments monthly, the total loan goes down. A reverse mortgage, you get the money, you don't make any payments, and the mortgage loan gets bigger. So instead of making lots of small payments every month, you just make one big payment at the end. When you move, you sell your house, or you die. So what's the main benefit of reverse mortgage? Is that you can access the equity in your home without having to sell your property, even if you don't qualify for traditional lending options. Now, how does it work? We're going to go into a few details a bit more to go to the intricacies of the reverse mortgage so you can understand it. But the main point is you can take the money in three different ways. You can take it as a lump sum, one big chunk in one amount at one time, lock it in like a regular mortgage. You can take it as a supplement for your income, where you receive it in separate installments every month, just as an additional supplement to your pension. Or you can take it as a home equity line of credit, so you know that amount is available for you to take whenever you need it. Things to keep in mind is the more flexible the product, the higher the interest rate. If you want it locked in one lump sum, it's going to be a better interest rate than if you take installments, or if you want full flexibility with a home equity line of credit. So now this sounds like a fantastic product, but how do you qualify? That's even better news. The qualifying criteria is actually quite manageable. The first thing, you have to be a Canadian citizen. You have to be at least 55 years of age or older. You have to have enough equity available in your home or a fully paid off home. And the last one, you have to have at least enough income to satisfy the minimum requirements of upkeep for your property, to make sure that it serves as a proper collateral for the life of the loan. That includes things like property taxes, condo fees, maintenance, utilities, and any other basics for the upkeep of your property. Now, this sounds like this product might be a bit too good to be true. So let's talk a little bit more specifically about the pros and the cons of a reverse mortgage. On the positive side, minimal requirements for qualifying. So if you already have low income or a minimal pension, you're already cash flow tight. It makes it much more accessible. 2, in Canada, you'll never be asked to sell your house to pay off this loan unless you decide to move, you decide to sell, or you die. There are some initial setup costs, just like any other mortgage or loan that you have to do that's based on a house. You'll need something like an appraisal, you might need a lawyer for title, you might need some other administrative costs. The benefit is, if you're already tight for cash and you can't afford those things, you can include those as part of the mortgage, but you will still have to deal with these initial setup costs. So you do have to pay for something to get it set up. The process itself is relatively quick, 3 to 4 weeks. And the main reason it takes longer is because it might take you time to set up the documentation, but more specifically, the banks want to make sure they're doing all the due diligence to make sure that this is the right product for you. On the bad side, there are consequences, of course, that have to do with reverse mortgages. So the first one seems kind of obvious, but it is a loan and you do have to repay it. Instead of having lots of little payments every month, you end up doing one large payment when you sell the house, when you move, or when you die. Now, this sounds obvious, but I point it out because most people will be surprised at the time of the estate. They think they're getting a fully paid off home and they realize there's this big debt that needs to be paid. So this is where family dynamics may make things a little bit more complicated, because they may be expecting this large inheritance, or somebody wanted that house and now they've got this loan that needs to be dealt. Now, this is important to mention because it's something that you should be having clearly written in your estate what needs to happen. If somebody did want to have that property for you, your beneficiaries have the option of applying for a mortgage themselves, so then they can pay off the loan and keep the house. If they don't want to do that or can't do that, then their next recourse will be to sell the house to pay off the loan. This is the same process that you would have if you were selling your house through a traditional mortgage with an already existing mortgage on it. the loan still needs to be addressed before the estate can be finalized. Another point to consider is interest rates. Reverse mortgages do have a premium on their interest rates, and this is for good reason. In a traditional mortgage, you get the lump sum payment, you're qualified based on your income, so you have the capacity to repay the mortgage yourself. And on top of that, you're making payments every month, which means the mortgage loan gets lower. This is reduced risk for the lender. On reverse mortgages, it's the opposite. You're not qualified to make the payments, you don't have enough income, and on top of that, you're not making any monthly payments, so the mortgage is getting bigger and bigger every month, which means the risk to the lender gets larger and larger every month. For that benefit of not making any payments and getting access to cash when you don't have the ability to service it, that is why the lender charges a premium for their loans. They're taking additional risk so you can get access to your money. They will get paid, but they're not going to get paid now. They're going to get paid at the end. And then point number 3, it's going to be harder to move if you want to change your home. The reason for this is the reverse mortgage program is designed to keep you in your principal residence for as long as possible. This means that if you decide you don't want to live in that house anymore, you just want to move and keep it as a rental, or keep it empty, or keep it for somebody else to use, you're no longer complying with the intended purpose of the loan, and it's going to trigger repayment. So at that point, somebody can loan you the money, or you can try to get the loan somewhere else, but somehow you're going to have to repay it or sell the house. So now that we understand the positives and the negatives of a reverse mortgage, I want to address some common misconceptions for the reverse mortgage program. Now, a lot of these misconceptions are because of our neighbors to the south in the US. The reverse mortgage program works very different, and when they first started, the policies were very different in Canada. In the US, there was a time where you could get more than 50% loan to value on a reverse mortgage, and at some point, if the property value dropped below a certain percentage, you could get called on your loan and you would be forced to sell your house. That's something that in Canada has never happened. The program started in 1987, and from that point onwards, not a single reverse mortgage holder has been forced to sell their house unless they decided to move, sell, or they died. Statistically speaking, is it possible that your property value could drop below your mortgage amount? Yes. We've seen it like in 2008 and other situations in a housing crisis where the property values can drop. What's different is here in Canada, it's built into their contracts, you have the guarantee that you will never be forced to sell. And it's statistically 99% of reverse mortgages in Canada still have some equity left in their house at the time that the property is sold. Another major misconception is that the older you get, the less you're going to qualify for, when it's actually the opposite. The reverse mortgage program is designed for older people who are retired or in their senior years, and the older you get, the more you're going to qualify for. Again, and the reason for this is the product is meant for you to stay in your home for as long as possible. So the older you are, statistically, the less you're going to live, the less the loan is going to be, so it's less risk for the lender. If you're 55, you're going to get less loan than you are if you're 85 requesting the same reverse mortgage. And like we were saying before, this is why qualifying depends on the type of property, location of the property, and age of the applicant. So now the next question, is the reverse mortgage the right product for you? The best answer I can give you, maybe. Maybe it is, maybe it isn't. It's going to depend on everybody's income, their location, their property, their specific needs, and their objectives. There's some cases where if it's for investment purposes, it might make sense. Maybe it's to travel the world. Maybe it's for something else. Depends on your personal priorities and what your plans are for your retirement and your legacy. So the idea is, if you want to know more, reach out to me, reach out to your broker, get the best advice possible to make sure you're making the best decision for you. Thank you for listening and taking the time to watch this video, because that means that you're taking the steps to making educated financial decisions for your future. If you like what you see and you want to know more, like and subscribe below and let me know how I can help you or what content you would want to see next. And if you want to know more, you can always book an appointment directly in my calendar. My information is in the description below. It can be a phone call or video call. You can tell me about your scenario and I can help you determine what might be the better option for you.